All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business.
Hey everybody, this is Matt Walters here with Lee Mackey.
Good morning.
Appreciate you joining us on another episode of The Market Moment. I'm excited to have a special guest with us today, Meera Pandit with JP Morgan. Really excited to get her thoughts on just everything going on in the markets, the economy, and kind of ask her some questions. She's an expert on things that we are not an expert on. So when we have questions, just like everyone should, we bring in some of the experts and get their insights. So Meera, we're super excited to have you this morning. Thank you for joining us.
I'm excited to be here. Thanks for having me.
Absolutely. Well, before we get in, we've got some questions we want to go through, but before we jump into that, just give us a little bit of a background of, you personally, where you're from, and then, maybe even more importantly, professionally, your background and how you got to where you're at, and then what your current role is at JP Morgan.
I'm a Jersey girl. I'm from New Jersey and spent most of my life on the East Coast, but I have also been a JP Morgan lifer, as we call it. So I've been pretty much a whole career at JP Morgan so far, about 15 years. And I've had a couple of different roles across asset management and wealth management. I've done everything from working with ultra high net worth clients to doing business strategy to now doing more of a macro strategy role here at JP Morgan. So as a macro strategist, essentially, I am conducting research on the capital markets and the economy. And really what that means for us is helping clients make better investment decisions or better informed investment decisions. We're not here to predict the future. We don't have a crystal ball, but we do want to help people see the present with clarity and really simplify the complex when we think about the fast moving and very dynamic markets and economy that we have at our feet here.
We'll just jump right in because you kind of teed us up nicely when you're talking about helping clients, provide clarity to what they're doing, the decisions they're making as it involves their money. So we're middle of May. We're in the middle of the second quarter of 2025 this year. If you had to describe it in one word, it might be volatile. Give us your thoughts on the first quarter and a half from a macro standpoint, and talk a little bit about the volatility that we've seen in the markets.
One of the things I want to highlight, and I think it's a good starting point, is that starting points themselves matter a lot. So we came into this year with 4 years of above trend economic growth. We've had an unemployment rate around 4% for 3 years. That's generationally pretty low. Wages have been growing even outside of inflation for the last 2 years. In the last 2 years, we had 2 back-to-back 20+% market returns with pretty low volatility. The dollar's been high for years. So we've been in an environment where it's been characterized by U.S. exceptionalism because the U.S. has been so strong both from an economic and market perspective. So irrespective of everything else that's happened this year, coming into 2025, we did expect some degree of normalization in these dynamics. Now, of course, the normalization that we've seen is probably sharper and perhaps a little bit more extreme than we were thinking in such a short time frame. But nonetheless, we were somewhat overdue for not sell America, but rebalance America a little bit in terms of some of these dynamics. So I do think that's an important thing to point out, that we have come from an incredible position of strength. Now, some of this volatility is certainly policy related. Again, I would argue that volatility in the markets was really a question of when, not if, this year. And yet tariffs and some of the rollout around new policy has somewhat given us the why. And I think that's because coming into the year, sure, people expected tariffs. The president has said it's his favorite word in the dictionary. But I think the magnitude of tariffs at first came in much higher than people were expecting. And then you see a swing in the direction to see that they've come in much lower now than people were expecting from a rate at which they stabilize. And we still don't quite know where tariffs are going to shake out. So I would also say if there is another word to define this year, it's been uncertainty. And I think we're going to carry that with us for the rest of 2025.
So real quick. So following up on that, one of the headlines, CNBC, Jamie Dimon comes out, says, hey, the market's maybe being a little complacent here and expects earnings growth to collapse. Are you surprised at where the market's at right now based on everything that we've seen in the first, quarter and a half of the year?
It's not just the market level that seems a bit higher than what we would expect given some of the risks out there, but it's also valuations on stocks. The overall index level doesn't always tell us as much as how cheap or expensive are stocks in aggregate. And stocks came into the year expensive. So to add to that starting point conversation, the starting point for valuations was high, and they're right back up to where we started the year as if none of this had ever happened. And the reality is that these different policy prescriptions are going to have consequences for the market. When we think about something like tariffs, for example, they're often thought to be stagflationary, slower growth, higher inflation. And we went from a tariff rate of about 2% last year to 25% after the April 2nd announcements. And now we've settled around 13%. So I think what the market is reacting to is, phew, we're not at 25%. But 13% is still a lot higher than 2%. And I think that's where some of these realities start to come in. If we also think about profits from a starting point, we came into the year with profit growth expected at 11%. Now it's something closer to 9%. But if we're in an environment where growth is going to slow, maybe we don't have a recession, but maybe growth still does slow down, it's going to be hard to see 9% profit growth. So I'd be more worried about that comment if we were expecting 3% profit growth and the calls were for profits to collapse. But at 9%, we have quite a bit of cushion, and that does seem like an unrealistic number given some of the headwinds to profitability.
And quick, sorry.
No, you're
sorry.
good. You're good.
On that, real quick, so do you think this is more of the markets being complacent or the markets doing a good job of what markets try to do and look out, and what's coming over the next 6, 9, 12 months?
I do think there is a dose of complacency when we think about some of the market risks out there. We talked a little bit about earnings. Ultimately, if we're in an environment where consumers are spending a bit less, then that's going to impact earnings from a revenue perspective. If tariffs cause goods and services to be a little bit more expensive, particularly on the goods side, not so much on the services, but overall price increases could have a broader impact, then that's going to impact margins for companies. So we would expect to see some degree of slowdown in profits. Now think about that PE ratio, the E on the denominator there. If that E is going down, your overall PE is going up. Mm-hmm. So as we see some of this repricing on earnings, potentially that actually moves valuations even higher. And when we are priced to perfection, we are a bit primed for correction. Sure. And it's not just around earnings, it's also the Fed is in wait and see mode. We are constantly oscillating between these trade optimism points and disappointments. We still have to see how the debt ceiling plays out this summer. And these are all the risks that we had already identified. Then there's the risks that we weren't necessarily expecting, like the US debt downgrade, for example, that happened earlier this week. Now, when we think about something like that, it's not that it was completely unexpected. It was, in fact, probably inevitable, but you have those spanners in the works that can be thrown in at any time. And in that context, it feels like the market is not appropriately discounting a lot of the risks we could see in the second half of the year.
A couple things. One, Matt got close to asking, but if in the first quarter and a half of this year, is there one thing other than the fact that we've bounced back pretty much to the levels that we entered the year at? Is there one thing that has surprised you about the markets or, where we're at in the U.S. economy?
We've also seen huge swings around what the Fed might do this year. We went from one potential Fed cut of a quarter point back in January when inflation was looking a little hot to 5 rate cuts in April during the height of volatility. Even 2 weeks ago, the market was pricing in around 4 rate cuts, and now it's pricing in about 2. So we've seen these huge swings in Fed expectations. We've also continued to see yields move higher. Even during the height of uncertainty, typically what you would see is people flee to the bond market, particularly treasuries, as a safe haven, and yet you only saw the 10-year treasury yield go down to about 4%. If you were to describe that week to me prior to it happening, I would have said, well, probably the 10-year is going to be at least at 350, maybe even lower than that, because everyone said, here we go, severe recession on the way, and this is very much heightened uncertainty, and that's not what happened. So it's been interesting to see massive repricing around the Fed. It's been interesting to see that yields continue to move higher. It's been interesting to see that the dollar has moved so much sharply lower. And in the context of all of this, most areas of the fixed income market are still positive and still did manage to protect portfolios. So squaring the circle around all of those items has been something that we wouldn't have expected coming into this year.
What do you see as we move into the summer months and then into the back half of the year to be the single biggest risk, if there is a single, if you can put your, crystal ball hat on, what's the single biggest risk to the markets right now?
Perhaps it's shifting towards thinking about fiscal policy and what happens around debt, the deficit, and the reconciliation bill. So right now you're hearing and watching a reconciliation package, which is essentially tax cuts and spending cuts, work its way through Congress. The expectation is that we'll get something from the House by Memorial Day. By July 4th, the Senate would have worked its way through it, and it'll find its way to the president's desk in perhaps later July or August. Now, there's a couple of risks there. One, it's likely that the debt ceiling is implicated in that entire package, and the debt ceiling essentially we breached, and now we are running through extraordinary measures to continue to fund the government. We keep pushing up against this debt ceiling every couple of years. And I think that's why you see the final downgrade from Moody's when we think about the overall credit rating of the US. Our debt and deficits are just not sustainable in the long run. I don't think we're going to default as a country, but certainly it's going to have impacts on growth and inflation in the long term. When we start to fold the markets into this, markets may not welcome tax reform as fiscal stimulus. Instead, they may rebuff it as deficit expansion. So my question mark is almost a little bit less around the equity markets directly, maybe the indirect impact of what happens around yields. Do yields move higher? And what level of yields are going to cause more challenges in the equity market? Because around 4.5 on the 10-year right now, and the equity market hasn't really blinked. Do we get to a point where there's a little bit more nervousness around that?
So a lot of this that we've talked about thus far, people listening be like, man, tariffs, volatility, like it all sounds a little spooky, right? If you look forward, looking forward, there's always opportunity. And there's always a chance that, not all of these risks come to fruition. Maybe some do, so maybe some don't. Maybe the market is impacted by some and not others. But what's the biggest opportunity as we move forward for clients in terms of looking at how they're positioning and managing their portfolios? Where's the most opportunity?
Over the last couple of years, we have seen that some of the biggest risks in the market are to the upside. In 2023, it was, we have this collapse of a regional bank, and this is going to infiltrate the whole financial system, and we're going to have another financial crisis. That didn't happen. 100% chance of recession. That didn't happen. We went into election season and people felt very emotional about the election. And there were certainly some real twists and turns in the election in 2024 throughout the year. And yet in both of those years, we had 20+% returns in the market. No one would have expected that if you had really been following the markets on a day-to-day basis during that time period. People said after the election, if this person wins, I don't want to have any stocks. If this person wins, I don't want to have any stocks. And yet we continued to notch all-time highs. So sometimes the biggest risk to portfolios is people being too conservative and then not growing their money enough over time. People say, I'm going to park in cash and just sit this out. And sometimes you sit it out for too long. And while you see your statement month after month and it doesn't change that much, you feel good about that until you get to the end of your time horizon, you're at retirement or you're ready to buy that house or send that kid to college. And all of a sudden you realize you didn't grow your portfolio enough to meet that eventual investment objective. So if we think about some of the upside risks this year, one is that when we think about slowing growth, we don't necessarily think we're headed for recession, but we might see a slowdown in growth. And yet, what we have seen time and time again is consumers engage in retail therapy. When people are the most nervous and the most concerned, they will instead go out and spend. I had a client who said, this was probably about 2 months ago, he said, gosh, my wife is so worried about tariffs. But she did just book us a 2-week trip to Italy.
Yeah.
So this is the mindset of the US consumer. We also have a very strong labor market. So broadly, if people have jobs and they feel pretty good about their jobs, they may continue to be able to spend. And I think we're seeing an element of this in the equity market. You're having retail therapy within the equity market where retailer investors still want to buy stocks even through this uncertainty. So it's interesting to see that move from the economy into the markets themselves. There is a case for resiliency of profits. There is a case for, hey, there's all of these headlines, but we still managed through it. So I don't want to discount, as you point out, the opportunities that we could see in the market.
It has been interesting. For all the negativity, like you just said, the markets continue to plow forward. JP Morgan's forecast for the rest of the year. I know Jamie Dimon spoke a couple days ago. What are your thoughts? What does the second half of the year, in your mind, bring us?
Remember that we have had about a 20% rally in just the last couple of weeks. So the market is up 20% from its lows. And so I think that the recovery, so to speak, from here on out is going to be much more gradual, and we could potentially be pretty range bound around flat for the year. We don't do official S&P 500 price targets because they tend to change throughout the year. So it's not particularly useful in that regard. I do think that the first week of April was probably the high watermark for volatility in terms of that type of intensity of a sell-off, but I still think you can see potential pockets of volatility throughout the rest of the year. So we want to be mindful that the market has already recovered quite a bit and that we have not eliminated all of the sources of volatility, but rather mitigated some of them. So we do want to be mindful that we have just come off of such an incredible run over the last 2 years. Valuations are high, risks are still out there. I think the best way to approach things is to consider some of the areas of your portfolio that are perhaps a bit unloved, that have really protected this year and really have grown this year. I'm thinking about bonds, I'm thinking about value stocks, I'm thinking about international stocks. These are all the areas over the last couple of years where people have said, why do I own these things? And this year is exactly why we maintain a diversified stance, because we don't want to sit out entirely and miss the 20% rally we've seen in the last 6 weeks. But at the same time, we don't want to be in the most expensive, well-trodden parts of the market either. This is, again, why we diversify, because some stuff that you like the least performs the best when you least expect it.
Your last point was one of the last points I was going to make, was that we've held on to fixed income, and it seems like you said the last couple of years. I could argue the last 10 or 15 years. Why have you owned bonds? Well, this has been a year where owning international, owning value, owning fixed income has really protected you in in the first few months of this year. So the modern portfolio theory, still lives, at least in the early part of 2025.
Quick question. So it's kind of out of left field, but we're talking about fiscal policy and what the Fed's going to do, and I think that's obviously everyone's that target has moved a lot since the beginning of the year, right? Like you said, if Jerome Powell picked up the phone and called Meera Pandit and said, "Hey, Meera, what do you think I should do?" Not JP Morgan stance, but your personal view on where do you think we should go from here? What would be your advice?
The Fed has acted cautiously so far this year, and I think that has been the right course of action. We may see slowing growth, although had the Fed done an emergency cut back in April, I think they would have regretted that, because it's looking like growth will slow less than perhaps we might have thought in early April. On the other hand, we might not see as much inflation as we perhaps would have expected in early April too, with more punitive tariff rates. So because we're still in this process of figuring out not only exactly what policy will be, but how it will pass through and impact the economy, I think the Fed is probably right to wait and see. They can always cut to preserve growth if they really need to. It's a lot harder to hike in order to stomp out inflation, and that's a little bit more sensitive right now. So I think the wait and see path of doing as little as possible until it's necessary is a smart one. especially because what we have seen is that after the 2 market years we've had, everyone expected, well, high rates are going to crush the economy, high rates are going to crush the stock market, and that simply hasn't happened. So clearly we have an economy that can withstand higher rates. People always say long and variable lags to monetary policy. Well, it's been a couple of years now, so I think that we've seen that impact play out already, and the Fed has in the end pretty deftly managed monetary policy despite a lot of twists and turns over the last couple of years.
Well, most people, 2 years ago never thought he could, land the plane with
landing.
Yeah. I mean, nobody thought that almost. And he was pretty successful. And now the flip side is in place and people are thinking he's not going to lower fast enough. And, maybe we just need to trust the process.
Well, I think as investors, and Meera, I'd love your input on this, but I think as investors, we've almost become kind of junkies on anytime there's something going on. We expect, monetary or fiscal policy to come in and save the day and smooth out inflation, where, my belief has always been just let the markets do what they need to do to flush things out from time to time. And I think we've been a little spoiled with, hoping that someone comes in and saves the day and smooths things out. Any thoughts on that?
I do think that's right. We have been very accustomed to getting massive rate cuts or massive fiscal packages in recent years. And we do need to wean ourselves off of that because you're always going to pay for it at some point, whether it's in the form of slower growth at some point or a recession, because you have had an overheating of the economy, or higher inflation when you think about an overheating of the economy. When we think about debt and deficits, again, we will pay for all of this in the long run. So I think trying to find a more moderate neutral stance as opposed to the sugar high or the shot to the arm is going to be really important over time to have more moderate policy responses.
Right. And investors have to remind themselves that, hey, to have the upside, like that comes along with it, the downside comes along with that. Nobody wants to accept that, but that's the reality. If you want the 20%, return opportunities, you have to be willing to ride out the volatility time as well.
Right. Volatility is very much a feature, not a flaw.
That's
within
right.
investing.
That's correct. That's
the,
correct.
The entry ticket into the game.
Yeah. I always tell clients, you're being rewarded, in those good years for being willing to go through the volatility. You can't just say, hey, I want the 20% and not have to deal with the downside. So
correct. Well, Meera,
what we typically see is we see about a 14% correction in the markets on average every single year, and yet 75% of the time markets end up higher. So 2 points. 1, the patient investor is often rewarded, and 2, we don't always know why or when we're going to see volatility, but we know that we will see it at some point. So we have built portfolios with that basic principle in mind.
One last question I have. All we have to go on is history when it comes to the markets, right? Looking back at what's happened when we've been in periods like this before. But the market itself, the fundamental structure of the markets, how people invest, how trading, is happening and occurs, has changed so much over the last 5 or 10 years, much less the last 20 or 30. So some of that historical data, it's not that it's useless, but it is, you have to take it, in the right context. How do you think, when you're looking at history, how useful is that? And how much do you think the market dynamics and market structure has changed to where, when for example, everyone's talked about the last few years, like these V-shaped recoveries, right? Some of these recoveries have been so quick. The sell-offs have been quick as well, but the recoveries, we've just come ripping back very quickly. Is that more of just the kind of environment that we find ourselves in, or is that more of a structural change that you kind of foresee that being the case over the coming years?
It's a bit of both. Look, history is helpful because it may not repeat itself, but it often rhymes. So it is a helpful guide. But when you think about the change in environment, and you brought this up just now, when we think about the massive fiscal policy that we've seen, the massive monetary policy going to 0% rates and negative interest rates in different parts of the world, starting to use the Fed balance sheet as a monetary policy tool, which is not really something we had done in this way in a long time. These have changed some ways in which the market has functioned. And so there's not so much of a comparison point to that. And then in terms of market structure, you not only see that algorithmic trading and some of the more mathematically driven models can create some sharp sell-offs, but also some very sharp recoveries. You can also see that there's been much more of a democratization in terms of investing, and retail investors can be trading on their phones. That's also going to change some of the positioning dynamics. So it's a mix of some of the unprecedented experiments in monetary and fiscal policy with some of these newer market structures that have resulted in sharper corrections and then sharper overall bounce backs.
Yeah. That's all I've got.
It's great. I mean, we like having these kind of opportunities to visit with, folks like yourself. Our clients appreciate it. And so, Meera, thank you for your time this morning. I know you're busy. Have y'all moved into your new offices yet?
Sometime between August and November, but it's up, it's running. Things are the desks are being moved in, so it's only a matter of time.
Well,
That's
good.
Awesome.
That's awesome.
It's a beautiful building. I wanted to ask you. I'm gonna toss one at you real quick before we leave. If for those listening out there wanting to just educate themselves and kind of get more up to speed on investing and the economy, what's one of your favorite books that you've ever read that you'd recommend to someone just wanting to get a little bit more up to speed on some of these topics?
A couple of years ago for Christmas, my father-in-law got me a book called The Economist's Hour, and it was a really interesting history of moving from probably starting in the early 1900s through almost today of different economists and their impact on administration and how policy changes were impacted by some of these different economic theories. And it was a really nice history, really, of fiscal and monetary policy, both bringing us to where we are today and how we shape some of the ideas that we have today when people say in economic theory, this would govern this and this would govern that. So I thought that was a really interesting intersection between economics and policy.
That's awesome. I've not read that, so I'll have to take note.
Wrote it down.
I'll go buy it on Audible. Hopefully they have an Audible version of it. But well, Meera, we appreciate you jumping on here with us. Really interesting conversation. Appreciate your expertise and insights and sharing those with our listeners. We hope to maybe have you on here again at some point. But enjoy the beautiful weather this time of year in New York, as you were telling us before we jumped on here. And again, we just really appreciate you joining us.
Thank you, and have a great week.
Thank you so much for having me. Do come visit the new offices when they're up and running.
We will absolutely do that for sure. Well, as always, we appreciate you guys listening and watching us. Give us a like, subscribe, email us your comments or questions, and we will see you guys next week.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com.